Hello, everyone. This is another short webinar like I used to do at the EAC, and I want to continue doing this for the health technologies community. And today I have the tremendous pleasure to have with me Alex von Frankenberg from the HTGF Fund and Marco Winzer. Alex is the managing director, and Marco is a partner with a focus on life sciences. Hello, both of you, and thanks for having time for us today.
Hello, Rick.
So, thank you both. So the plan is to provide a bit of information to the health technology community. And I had two ideas in mind. First one, as an ex-investor at the EAC, and from my colleagues at the EAC and other investors, a big question was always, how do we get good multiples, good ROI, being a public or public-private fund? And I've been amazed to hear your story and how you managed to get good multiples for Fund 1. That's amazing. I think there's a lot of content. So I'm going to have just two questions for you. The first one is to help investors like myself and others, and to help entrepreneurs. That was my second question. So first question, tell us a bit about the story and maybe a bit about yourself, if you like, and what are the lessons to get good ROI being a public-private VC fund? Who starts?
I can quickly start, and then maybe Marco can specifically point out the life science aspect, which is outperforming the other areas in our fund, at least in Fund 1, and I think also 2. So we both have been with the fund now almost 20 years. And we're like an early stage seed investor, and I think investing very early is one component of not only getting in at a lower valuation, but also being able to shape the investment. So if you invest in Series D, of course you can add value and you can have some influence, but you can shape much more. And when the companies are younger, and that's what we do, shaping in terms of adding value. And then, if you add value early, then the value multiplies. And maybe another aspect is staying invested for a long time. And it's difficult with a fixed duration of the funds, but things take time. And especially deep tech in any area, especially life science, it does take time. And having the stamina to stay invested for, and maybe Mark can say an example, for 20 years, drives up the performance. And there's a chart I've seen that 94% of the value is created after 10 years with the big successes in the US. So staying beyond 10 years is difficult sometimes, but it could drive valuation. And then before I hand over to Marco, I mean, the general aspect is to find teams and technologies that solve big problems. The bigger the problem is, and then the solution, the higher the value is that's being created. And of course, that drives return. So maybe, Marco, you can add, especially with the life science angle.
Yeah, thank you, Alex. What I wanted to say is that I mean, yes, Alex has said it, we go very, very early. HTGF is a seed investor, sometimes even pre-seed investor. But it doesn't mean that we make our investment strategies spray and pray. Yeah, not spray and pray. No, we are very selective also in the seed phases. And what does it mean? It means that we go in a very early stage when companies are already not founded. We go to university, to R&D institutions like Fraunhofer Max Planck Helmholtz in Germany, and we want to meet the founder teams before they have their final pitch deck and their final business plan. So we want to be in communication with them and give our perspective on their ideas and their business plan. We call it so-called investor's perspective in your business plan in a very early and non-confidential room, so that we work with the founders together. And what we are doing, we give our input concerning what value inflection points along the clinical, preclinical, or even regulatory pathway in the regulated medical device or pharmaceutical markets, what value inflection points could be reached with the funding of HTGF? This is always the main question we have, even in these very early phases.
That's super interesting.
Maybe one more aspect I think it's important to add. You do initial investment and you do follow-on investments. And it's really difficult to concentrate the follow investments on the best companies, because first of all, you don't know what the best companies eventually will be. So it's hard to know even if you're invested. And of course, the not so good companies, they ask you very nicely for follow-on investments. So if the share of the follow-on investments is mainly concentrated on the performance drivers, that drives the return of the fund. It's easy said, but it's very difficult done.
Yeah. This is and very hard sometimes for us, but also for the companies, for the founders. So you didn't reach your value inflection point. How can we handle it? Yeah, because there is no automatic follow-on investment by HTGF. Yeah. So please, how can we handle it? Yeah. And we handle it very often because we can create strategies around, but we wanted to see how the performance in kind of the value inflection point is going up. And with this, of course, for an early stage investor like HTGF, it's very important what is the company valuation in follow-on rounds. Very important question.
Yeah.
One of the things we saw at the EAC, I think the EAC also implemented this approaching universities and coming in really, really early. But then what I saw was that this was really, really time consuming. So you have a small VC team. How do you manage that? How do you approach universities at early stage, talk to academics? The time flies. Now I remember I had this fantastic conversation, but I look at my watch, it's been 1 hour. And of course, you're talking science. It's really pre-company. How do you manage that? Do you have a team doing that? Or how do you address that to make it efficient?
Yeah, sure. We cannot do it by ourselves alone. Yeah. We are cooperating very strong together with tech transfer institutions and with incubators. Yeah, for example, in Berlin, the Charité, they are very active in tech transfer, in incubating their founders. And so we are working with them very strong together. And then we organized so-called pitch days. Yeah, we have a medical device pitch day, open pitch day, where we invite founders and startups, but also potential corporates in the sector and potential investors in the sector. And this is a very important deal flow pipeline for us because the companies, the startups are pitching, and we see the questions coming from the industry, but also from late stage investors. And these questions we have to address with the founders. So we have special events, to coming in a very early stage together with these founders. This is, I think, the norm. Yeah.
It's a very good concept.
So partnerships is very important, and I can add, I had a boss many years ago before I had a Gründerfonds, and he said the biggest driver of the output is the input. So what we also do, we work quite a bit. So we're not an investment bank, so we don't work until 2 o'clock in the morning, but it's not an 8-hour job. And we also, and it's I think a little bit important for mainly public fund, we do have performance standards, and you have to have that, of course, obviously in the portfolio, but we also have it in the team. So but it's not an investment bank. It's really important. It's not McKinsey, but we do have standards, and if someone for quite some time doesn't meet the standard, we ask the person to leave, and I think it's it sounds a little bit tough. And it is tough, but it's not over exaggerated. We try to keep the standard high, and that's difficult in private companies. I think it's even more difficult in public companies.
And how do you measure the standard? What's a standard? What's a KPI for a member of the team? Because if it takes 10 years to get to an exit, it's difficult for you to evaluate quantitatively when a team member is not performing. No, I mean, you get a feeling not based on the exit, really. It has to come earlier, not a decision of that team member.
Yeah, we do. I mean, we have many KPIs that are actually not so difficult to measure. And I mean, one KPI, we do 40 investments per year, and we break that down on the teams and then on the individual investment managers. And of course, you can have some bad luck, and then you have 2 investments, and then you lose them on the finish line to other investors. That of course can happen. But if someone is failing the investment targets for a number of years, or if you can see the person not making the effort, not going out talking to founders, and sometimes we get feedback from founders that they didn't get a response for 6 weeks. They sent in their business plan and then didn't get a response. Now that's not so smart, because if it's a really good team, it's gone. I mean, you lose it. We do a net promoter score every year for the whole fund, and we measure the net promoter score, and then if a person has you get feedback, and if the feedback is significantly over average, not so positive, then it's clear.
Yeah.
And then over the long run, yes, you can measure the value development of the portfolio. It's a little bit difficult, because if a company is profitable, for example, the value doesn't go up because it has no market valuation. So we try to be a little bit smart about it, but we do have, I mean, over the 20 years, we had, I think, I don't know, 6, 7, 8 investment manager portfolios that lost more than 50% of the money. And that of course can happen, but I mean, all those people are not with the fund anymore.
Yeah, makes sense. Perfect. So, as a summary, for VC funds with private public sort of a structure or public structure, you're suggesting go in early. So you need to source to have a good deal flow, and you can do that by organizing pitch days, work with incubators, generate deal flow, but come in early. Be ready for follow-on, but very careful in selecting those follow-on investments. Stay invested, be ready to stay invested long term. I heard the 10-year sort of mark, like an idea figure. Very good. Perfect. So my second and last question, for entrepreneurs who might be in the audience right now, what are you looking for? How can we help them align what they have, their pitch decks, their business plans, with what you're looking for? Stage, you said seed stage mostly. Give them a bit of a few tips. How could they align with HTGF?
Alex, should I go or go?
No, go ahead, Marco. Go ahead.
No, I add for the life science afterwards. Yeah.
I mean, first of all, you can contact anyone. You can contact, I mean, we're a large team of 50 investment managers, 3 managing directors, and you can connect anyone. It doesn't make sense to connect all of us. One is enough. And then what we do, we collect all the incoming business plans, and we distribute them in 3 different deal flow meetings every Monday to a deal team. And of course, if you have a introduction of, if you get introduced by someone who we value, who's very, very competent, then of course we appreciate it. It's not necessary, and so you can send it an email. And the 50 investment managers, I would guess they're like 2 days on a week on the road, so like 100 days per week we are on events, 50 to 100 days. So you can approach us directly, personally, and do the famous 2-minute elevator pitch, and build some relation, try to convince. Because if you can explain what you have, what you do, it might be better, because sometimes it's a bit more difficult to understand from a PowerPoint presentation versus having a short conversation. And then I think the key ingredients, I personally, of course, most important is who are the founders? What have they done? I mean, are they people where you could believe that they want to implement what they're proposing? And then, of course, what's the proposal? What's the problem that's being solved, and how do you solve it? And what's special about your approach to other approaches of other companies, competitors? And then, of course, it's a little bit important how much is the initial funding need. If you need 20 million to just start, we might be the wrong partner in some cases, because we can only invest a maximum of 2 million initially. Especially in the life science area, we have the capability of building large consortia very early. So 20 million might be possible and has been done, but that's the question: can you get the amount that you're proposing to get started? Can you raise it? So and then, of course, a little bit the valuation of the initial valuation is 100 million. Might be difficult for us. And what's very important, we are not looking necessarily only for unicorns. So if the capital requirement is low, maybe in the software space, you need 1 million to grow the company, which is possible. Then if the company eventually is being sold for, like, just for example 20 million, it might be a good investment case. So we're not, we see in terms of every company we invest in needs to have the potential to pay back the fund. So we are a little bit more modest, and that relates a little bit to the public background that we have. We do want to make money. We don't want to lose, and that's why we're making money, because we want to. We're looking for good investments, but they don't have to be like the 100x initially.
Perfect.
One important thing, I think it's important for the entrepreneurs or founders here in the chat, look at my background. There's written, we invest in people. And this is very, very important for us as a seed investor. You know, I've never seen a business plan who will work exactly as planned. Never. Yeah. Sorry for that, entrepreneurs. So that's the reason why we look very intensively during due diligence into the team. Yeah. And is the team able to shift some problems? Is the team able to give other solutions? Is the team able to make a pivot of the business plan or whatever? So invest in people. This is important for us, into the brains of the people and not into the pitch deck or the business plan.
Very good.
Yeah.
Thanks so much for that. Sorry, go ahead.
And just do it. I mean, we have seen so many surprising successes that even if we're critical or others are critical, just do it. If you believe in what you do as a founding team, and others don't understand it, including us, still do it.
Yeah.
Very good. Perfect. So quick summary then. Those that want to approach you, they should approach one person, not many on LinkedIn or everywhere. They can find a place where you're going to be, because you are on the road 2 days per week. So it's easy to get in person time with you. People is the most important thing. I think for us, we felt the same thing when we were at an interview at the EAC program. The decision was really based on the people we had in front of us. Of course, the market and the product, it was important, but the people was the most important thing. And valuation should be reasonable, because you're coming in early and you want to have an upside there. And yeah, that's really super useful. That's clear.
Yeah.
Thanks so much.
One advice: look on our webpage. There, all the pitch days are published, and apply for the pitch days. If you are in digital health, medical devices, chemistry, biopharmaceuticals, please apply for the pitch days. That's the easiest way to get in contact with one of my colleagues.
Fantastic. That's a very nice procedure you have established. This pitch sessions you can apply for online. That's fantastic. Good idea. Thanks so much, both of you, Alex and Marco. Thank you.
Thank you, Henrik. Good.